In this video, we will discuss when should a firm recognize income on income statement. For financial reporting purposes, an income statement is created using the accrual accounting principles. Accrual accounting requires that revenue be recorded when earned and that expenses be recorded when incurred, irrespective of when the related cash movements occur. The purpose of accrual entries is to report revenue and expenses in proper accounting period. Because accrual entries occur due to the timing difference between cash movements and accounting recognition of revenue and expense, it follows that there are only a few possibilities. First, cash movement and accounting recognition can occur at the same time, in which case there is no need for accruals as the firm will receive and make cash payments as they become due. Second, cash movements may occur before or after accounting recognition, in which case accruals are required. The possible situation requiring accrual entries are summarized into 4 types of accrual entries as shown in the following exhibit. Unearned or deferred revenues arise when a company receives cash prior to earning the revenue. Unbilled or accrued revenue arise when a company earns revenue prior to receiving the cash. Prepaid expense arises when a company makes a cash payment prior to recognizing an expense, and accrued expense arise when a company incurs expenses that have not yet been paid as of the end of the accounting period. The ultimate goal of a firm is to create wealth for shareholders by generating more cash inflows than it incurs cash outflows. Then why don't we simply report cash inflows and outflows? Why do we need an income statement? Well, simply reporting cash inflows and outflows would suffer from timing issues as a measure of firm performance and financial condition. Let's look at an example. Suppose a firm purchases supplies on December 31st, 2013, uses the supplies to provide services to a customer next year, and collects cash for the billed services the following year. Under cash flow reporting, income from this transaction appears in 3 reporting periods in the following pattern: minus $100 in first year, $0 in the second year, and $1,000 in the third year. Whereas under accrual accounting, the net of $900 appears in a single period in which the activity occurs. In this example, we see that reporting cash inflows and outflows yields a series of performance measures that vary from negative to 0 to positive, whereas accrual accounting measures and reports when and how the value changes are generated. The accrual accounting approach moves the timing of income and expenses to the period in which real activity occurs, which in this case is 2040. Now let's move our discussion to income taxes. Everyone is aware that taxes are a significant aspect of doing business, but a very few understand how taxes impact financial statements. The fundamental reasons for the difficulty in understanding the financial reporting of income taxes is that the financial reporting of income uses a set of rules set by US GAAP, while taxable income uses the rules provided by the IRS. The differences between these sets of rules triggers differences in the timing and the amount of tax expense on the income statement and the actual taxes payable to the government. There could be permanent tax differences, which consist of revenues and expenses that firms include in net income for financial reporting purposes, but that never appear on the income tax return. For example, the amount of interest earned on the municipal bond is a permanent revenue difference, as the interest income on municipal bond is tax exempt. Other examples of expenses that would be disallowed as deductions by IRS include executive compensation above a specified cap, certain entertainment expenses, political and lobbying expenses, and some fines and penalties. The difference in tax and accounting rules can also lead to temporary differences. There are revenues and expenses that firm include in both net income and taxable income, but in different periods. These timing differences are temporary until they reverse. Straight line versus accelerated depreciation expense is a temporary difference. For example, the firm recognizes total depreciation of $120 over the life of the equipment for both financial and tax reporting, but in different pattern over time. Similarly, warranty expense is a temporary difference. For example, a firm recognizes a total of $20 of warranty expense over the 2-year period for financial reporting. It deducts only $16 over the 2-year period for tax reporting. If the firm's estimate of total warranty cost turns out to be correct, the firm will deduct the remaining $4 of warranty expense for tax reporting purposes in the future years when it provides warranty services. More details on income recognition and taxation are provided in the text. Please carefully review chapters 1 and 2 from the textbook before attempting the first quiz. In the next set of videos, we'll talk about accounting quality.